So Evercore completely crushed consensus this quarter. I mean, we are talking a massive top-line beat. Adjusted earnings per share came in at $2.91, and adjusted net revenues hit $999.5 million.
Wow.
Yeah, that is literally a rounding error away from $1 billion in a single quarter, which is up 19% year over year. You're diving straight into Evercore's second quarter 2026 earnings report today, and we're just cutting through the corporate jargon to see how this independent investment bank is actually performing. We've got these huge top-line numbers of, frankly, insane 201% explosion in underwriting fees and a forward strategy that aggressively targets corporate distress, which the market obviously loved given the huge capital returns they announced.
Yeah, when a firm like Evercore posts, nearly $1 billion in adjusted net revenue for just one quarter, it signals something really fundamental about the velocity of capital right now in the broader market. I mean, you don't just see 56% top-line growth in a 6-month period without multiple macroeconomic engines firing all at once.
Bringing their first half revenues to, what, $2.4 billion?
Exactly, $2.4 billion, and we are looking at an adjusted operating income of $189.7 million for Q2 alone. So it makes total sense why the stock reacted the way it did.
Well, leadership is naturally taking a massive victory lap here. Founder Roger Altman called it the strongest first half in our history. And, that carries serious weight since the firm has been operating since 1995.
Oh, absolutely.
And CEO John Weinberg pointed to broad-based strength and intense client engagement. But I read those quotes and I immediately have to ask, is this Evercore's actual strategic execution? Like, are they out-executing their peers? Or are they just catching a massive rising tide in the M&A and equity markets?
Well, the broader market definitely provides a huge tailwind, right? But you really cannot accidentally stumble into a 19% revenue increase in a single quarter. Hitting the strongest first half in a 30-year history, that requires a highly calculated structural setup.
Because these deals take forever to close.
Right, exactly. The M&A cycles we're seeing close today, those were seeded 12 to 18 months ago. So capturing these fees means Evercore had the right senior managing directors already in place, specialized in the right sectors, right when those clients decided to greenlight a deal.
Right. A rising tide lifts all boats, but they built a bigger boat.
Exactly. They spent the last 3 years heavily recruiting specialized talent to ensure their sale was massive when the wind finally picked up.
So let's look at exactly where that revenue is coming from, because the growth is really heavily skewed towards specific units. Their advisory fees, which is the traditional bread and butter of independent banks, reached $775.6 million on an adjusted basis. That's an 11% increase year over year. They logged 132 distinct fees of at least $1 million in this quarter alone.
Yeah, up from 111 last year. And the scale of the transactions generating those fees is just staggering. I mean, we are talking about Evercore advising on Arcosa's $8.5 billion sale to CRH and Iridium's $8 billion sale to Rocket Lab.
Which obviously goes way beyond just, introducing a buyer to a seller.
Oh, totally. Advising on an $8 billion transaction is an incredibly complex mechanical process. Their bankers are out there building massive dynamic financial models to justify the valuation. They're drafting fairness opinions to protect the board of directors from shareholder lawsuits.
Right.
They are navigating antitrust considerations, structuring the debt and equity mix. It's a huge lift.
And they also advised Victoria's Secret on a successful proxy fight this quarter, which highlights a totally different tactical muscle. In a proxy fight, you aren't modeling a sale, you are actively campaigning. You're helping a board of directors convince institutional shareholders not to vote for a slate of hostile activist board members. It's strategic defense, and that commands a massive premium.
It does, and it diversifies their advisory revenue stream, ensuring they aren't entirely reliant on pure M&A volume. But the true outlier in this report, the number that just completely warps the baseline, is the underwriting revenue.
$97.1 million.
Yeah, that is a 201% jump from Q2 of 2025.
And transaction volume doubled, right? Going from 13 underwriting transactions where they acted as a book runner to 26. But wait, a 100% increase in volume resulted in a 201% increase in revenue. So the yield per deal must have just skyrocketed.
It did. And that yield expansion comes entirely from their placement within the underwriting syndicate. They acted as an active book runner on Parabilis Medicine's $771 million IPO, which, by the way, was the largest biotechnology IPO in history.
That's huge.
And they also served as the lead left book runner on Red Cat's $259 million follow-on offering.
Lead left being the critical distinction there.
Right, because in the prospectus for any public offering, the banks managing the deal are listed on the cover page. The bank listed on the top left, the lead left, is the one actually driving the process.
Got it.
They organize the roadshow, they gauge institutional demand, set the final offering price, manage the order book. So because they take on the heaviest workload and, frankly, the most reputational risk to stabilize the stock once it starts trading, they command the lion's share of the underwriting economics. Evercore isn't just participating in syndicates anymore, they are anchoring them.
Which brings up a serious question about sustainability. I mean, a 201% growth rate in underwriting feels less like a new normal and more like, a dam breaking. We saw this massive backlog of deferred capital market activity stall out in late 2025. Did a 2-year pipeline of IPOs and follow-ons just slush through the system all at once?
Yeah, treating a 200% growth rate as a permanent run rate is incredibly dangerous. It heavily suggests a backlog clearing. You had all these private equity firms and VCs who were trapped in aging investments, and they finally saw a uniquely accommodating window in the equity markets.
So they rushed their portfolio companies to the public market simultaneously.
Exactly. Evercore is undeniably capturing more market share as a lead book runner, which permanently elevates their baseline, sure. But expecting $97 million in underwriting to repeat sequentially every quarter just ignores the cyclical reality of capital markets.
Yeah, fair point. But there is one segment that acts as a buffer against that volatility, which is investment management. Wealth management showed steady, unspectacular, but really vital growth. Asset management and administration fees rose 15% on an adjusted basis to $24.6 million.
Fueled by a 12% increase in assets under management, bringing their total AUM to $16.2 billion.
Which is pretty solid.
Yeah, and that growth is a mix of broader market appreciation, the underlying stocks in the portfolios going up in value and net new capital inflows from clients.
It's recurring revenue. It doesn't rely on closing an $8 billion acquisition to generate cash. It provides a stable floor for the firm. But, generating nearly $1 billion in revenue across all these segments means nothing if the costs required to execute those deals just destroy the operating margin.
Right, absolutely.
So we need to look at the single most scrutinized metric for any investment bank, the compensation ratio.
Yes. Evercore's adjusted compensation ratio dropped to 63.5% this quarter, which is down from 65.4% a year ago.
Even though the actual raw dollars paid out to employees rose to $634.6 million.
Right. The total payout went up, but the firm became vastly more efficient.
It's classic operating leverage. Think of it like a high-end restaurant, right? The head chef is being paid more this year. But because they are turning over so many more tables, the relative labor cost as a percentage of total sales actually shrinks.
That is a great analogy. And that efficiency drop is the primary catalyst driving their adjusted operating margin up to a massive 19.0%.
But the mechanics behind that raw dollar increase in compensation are also worth unpacking. It wasn't just higher base salaries. Management specifically cited higher amortization of prior period deferred compensation awards.
Yeah, we should definitely break down that deferred comp mechanic because it really dictates how senior bankers actually build wealth. When an Evercore managing director earns a massive bonus for closing a deal, they don't get handed a briefcase full of cash.
Right, unfortunately for them.
Exactly. A significant portion of that bonus is paid in deferred company stock that vests over a 3 to 5 year period, and it creates a forced long-term alignment.
Because if a banker executes a terrible acquisition for a client just to secure the fee, and that client's business blows up 2 years later, the reputational damage hits Evercore's stock price.
Exactly. And because the banker's deferred compensation is tied up in that same unvested stock, they directly suffer the financial consequence of their own bad advice.
Wow.
So the amortization cost hitting the balance sheet this quarter is simply Evercore mathematically accounting for the stock they promised to bankers in previous highly successful years that is vesting today.
Okay, so compensation is locked in. Let's look at the non-compensation costs, because those surged as well. Adjusted non-comp costs rose 32% to $175.2 million. Management pointing to higher business activity, overall headcount growth, a provision for credit losses, and notably, elevated travel pricing.
Yeah, elevated travel pricing is such a fascinating window into the reality of high finance execution. You cannot advise a board of directors on an $8 billion hostile takeover or, manage a global IPO roadshow via a spotty video conference.
No, you definitely can't.
These deal makers are physically back out on the road. They are flying private, renting out hotel conference centers for weeks at a time, sitting across the table from clients. When you're closing mega deals, the travel budget expands exponentially, and inflation in the luxury travel sector hits the balance sheet directly.
Makes sense. The provision for credit losses is another detail that requires some context, though. Independent advisory firms like Evercore aren't massive balance sheet banks like JP Morgan or Goldman Sachs. They don't typically lend billions of dollars to their clients. So why are they suddenly setting aside a provision for credit losses?
Well, even independent advisors occasionally utilize their balance sheet to bridge a transaction or support a specific underwriting arrangement. When transaction volume doubles like it did here, the incidental credit exposure scales with it. So accounting rules just require them to estimate and reserve capital for the statistical probability that some of those minor credit extensions might not be repaid. It's just a byproduct of being a lead book runner and driving the syndicate. You take on slightly more friction risk.
Right. And we should also clarify the gap between the U.S. GAAP numbers and the adjusted numbers we're using to analyze their core performance. Evercore backed out a $21.3 million special charge related to an estimated loss provision for non-U.S. employment taxes for prior periods.
Right.
They also backed out lingering costs and intangible asset amortizations related to their previous acquisition of the UK advisory firm Roby Warshaw.
Yeah, stripping out those one-off historical charges gives us the actual operating run rate of the business today. And once you isolate that pure operating cash flow, the immediate focus shifts to capital allocation. How is Evercore deploying the cash remaining after they pay their bankers and cover their travel bills?
Yeah, what are they doing with it?
It comes down to managing tax liabilities, acquiring new talent, and aggressively returning capital to shareholders. And the tax strategy alone is pretty brilliant. The GAAP effective tax rate dropped to 27.8%, down from 29.3%.
Right.
And the firm explicitly stated this decrease reflects a tax deduction associated with the appreciation of the firm's share price upon the vesting of employees' share-based awards.
It is a phenomenal quirk of the corporate tax code. When Evercore grants stock to an employee as part of their bonus, that stock has a specific market value on the day it's granted. But the employee cannot touch it for years.
Right, because of the vesting schedule.
Exactly. If Evercore performs exceptionally well and the stock price doubles by the time that stock actually vests and transfers to the employee, the tax code allows the company to claim a deduction based on the much higher fair market value on the vesting date, rather than the lower price on the grant date. So because the stock performs so well, the gap between the grant price and the vesting price created this massive oversized tax deduction. They essentially get to write off a larger expense than they originally accounted for, which drives down their effective tax rate and keeps more cash in the business.
It's a compounding benefit of a rising stock price.
Definitely. And that rising stock price is also the primary currency they use to aggressively expand their talent pool. As of June 30th, the firm employs 188 investment banking senior managing directors, but they are actively scaling up.
Yeah, they announced 4 recent S&D hires focusing on industrials, private capital, and healthcare.
And they have 7 more SMDs committed to join shortly. These new hires are highly targeted. They're expanding their Frankfurt office, beefing up equity capital markets, and bringing on heavy hitters in chemicals and restructuring in both the U.S. and Europe.
Hiring senior managing directors away from rival banks requires immense upfront capital. You have to buy out the unvested deferred compensation they are leaving behind at their old firm just to convince them to move. The fact that Evercore is willing to absorb those massive upfront buyout costs signals immense internal confidence in their forward-looking deal pipeline. They obviously see enough impending transaction volume in industrials and healthcare to justify the immediate margin hit of onboarding elite talent.
It also highlights the sheer volume of unvested equity floating inside Evercore itself. The report notes they have 4.4 million unvested restricted stock units outstanding. The aggregate grant date fair value of those unvested RSUs is $1.1 billion.
Wow.
$1.1 billion in stock that employees have been promised but haven't fully earned yet. This acts as the ultimate retention mechanism.
We talked about this dual piston engine of RSU compensation earlier, and SMD generating tens of millions in advisory fees is constantly being courted by rival banks. But walking away from Evercore means abandoning millions of dollars in unvested equity. It locks in stability at the senior levels.
And more importantly, it acts as a direct catalyst for performance. The future value of that $1.1 billion is entirely dependent on the firm continuing to grow revenue and manage costs. The bankers are hyper-incentivized to close deals because their own net worth is directly tethered to the equity they are holding.
And that hyperalignment is what generates the cash flow required for the final pillar of their capital allocation shareholder returns. Evercore declared a quarterly dividend of 89 cents per share. But the dividend is just a fraction of the story. Year to date, they have returned a massive $822.9 million to shareholders.
The vast majority of that return was executed through aggressive share repurchases. They bought back 2.3 million shares at an average price of $324.60,
Right.
returning over $800 million in just 6 months, while simultaneously eating the cost of hiring 11 new senior managing directors, demonstrates incredible liquidity.
It does. And buying back stock at $324 a share also communicates the board's belief that the intrinsic value of the firm is significantly higher. It mathematically increases the ownership percentage for remaining shareholders and, permanently removes those shares from the dividend obligation pool, which frees up future cash flow.
It's an incredibly dense, fundamentally robust earnings report. Let's recap the critical mechanics we've unpacked. Adjusted net revenues approached $1 billion, driven by an 11% increase in mega deal advisory and a historic 201% surge in underwriting revenue.
Yeah.
They managed this growth with strict operating leverage, dropping their compensation ratio to 63.5% despite higher total payouts. And they capitalized on their rising stock price through tax deductions and aggressive share repurchases, returning $822 million to investors.
The headline numbers definitely paint a picture of a booming macroeconomy. But if you analyze where Evercore is actually deploying its human capital for the future, a massive contradiction emerges.
What do you mean?
Well, they are aggressively hiring senior managing directors specifically for restructuring in the U.S. and Europe. Restructuring bankers do not operate in a booming economy. They specialize in corporate distress, navigating bankruptcies, negotiating debt-to-equity swaps with aggressive creditors, and, breaking up failing companies.
It's the ultimate counter-cyclical play. Evercore just posted their strongest first half in history based on corporate confidence, M&A expansion, and a flood of IPOs. Yet, their internal forecasting is commanding them to actively beef up the team responsible for corporate distress right now.
Exactly.
They're securing the talent required to manage a wave of bankruptcies and debt workouts. It really leaves you wondering what their proprietary data is showing them about the underlying health of corporate balance sheets over the next 18 months that the broader equity markets are currently ignoring.
Yeah, when an independent advisory firm starts paying top dollar to poach restructuring specialists, they're preparing for the weather to change.
And that is the exact insight you need to extract from these filings. It's not just about the revenue generated yesterday, it's about how the capital is being positioned for tomorrow. Thank you for joining us on this deep dive into Evercore's Q2 earnings. If you want to stay ahead of the curve and understand the mechanics behind the numbers that actually move the markets, make sure you follow the show for our daily, concise earnings coverage. We will see you on the next deep dive.